Hello and welcome to Macro Mondays. I'm James Todd, standing in for James Brody, who's away this week.
I'm Will Cunliffe, a research analyst here at Onyx Capital Group.
And I'm Ed Hayden-Briffett. I'm also a research analyst here at Onyx Capital Group.
As always, we'll be looking at key market data, charts and risk, and analysing stuff that's gone on in the previous week. Jerome Powell flipping dovish on the Fed is one of the big talking points for the week. It ties in with a lot of what we're seeing in other assets and markets.
Trump has also been upping the pressure on the Fed with a threat to fire Lisa Cook.
And we've seen the US Treasury curve, yield curve steepen, along with key updates from China and Europe as well in other macro markets.
So yeah, let's start off. Big news last week, Jerome Powell sounds more dovish. Is this playing into Trump's hands? Is this playing against Trump here? Seems like Trump is going to be quite trigger happy and supervising the entire situation as it goes forward.
Yeah, I mean, it was quite surprising in a way how dovish Powell was at Jackson Hole. I think a lot of people were expecting, a lot of commentators were expecting him to kind of come out and maintain that slightly more hawkish stance, but he didn't. And we've seen a number of different pricing reactions. One has been an aggressive steepener in the yield curve. That's been a bull steepener. So a lot of the 2-year being sold, while the kind of 30-year and the 20-year and the 10-year remain a little bit more anchored. But you can see the big steepener there is in the 230s. And that's really steepened aggressively. So that back end yield is holding fixed. I mean, yeah, so some of the narrative coming out of Jackson Hole was really seeing inflation, still upside risk, but really the focus is on employment.
Well, this is it. I mean, the quote coming from Powell, risks in inflation are tilted to the upside and risks to employment are tilted to the downside. It is possible that tariff-driven upward pressure on prices could spur lasting inflation dynamic, but it is unlikely given downside risks to the labour market. So, he's still acknowledging the risk of inflation here, the damage that things are doing to unemployment.
Yeah.
So to have this sort of slightly dovish stance is a bit out of left field.
I think it was really surprising to the market as well, because if you look at the OIS pricing of a September cut going into the Jackson Hole symposium, it was about, I think, 18 bips were priced.
Yeah.
Whereas immediately afterwards, you got up to 23, 24 bips.
Yeah.
It has moderated early this week down towards 20 again. So really, you can tell that the market wasn't expecting this. I certainly wasn't. I thought he'd continue his hawkish tone throughout.
And it's also, breaks the narrative of what we've seen over the past pushing 12 months or so. Trump was very vocal and critical of Powell and the Fed before the election, even in November, let alone before the inauguration.
Yeah.
And we have had cuts over the past 12 months in that same period, but yeah, it's sort of I think it is. Let's say that it caught a few people off guard. I don't know. Do you think it's external pressure from Trump himself that's maybe flipping Powell like this?
I think that's unlikely. I think Powell will be maintaining his stance of let's look at the data, let's consider what we know, and it's true that inflation has been slower to pass through than I think many people expected. While we did get a pretty hefty downward revision to payrolls in the most recent print, and that will skew risks at the Fed. When their dual mandate is in tension, they need to consider how far the economy is from either target, and the mandate which is furthest from target is the one that they need to prioritize. So if labor market softness is really driving the Fed policy decision, then that's interesting. And that's been a clear pivot from the Fed.
Yeah, I guess it also depends on what they see to be the sort of primary concern, as you said, like labor market versus inflation. And if inflation, I think especially with these tariffs, there will be inflation from them, but quite a lot of people seem to be looking at this as perhaps shorter term inflation rather than longer term systemic inflation, and it's supply chain stocks, it's foodstuffs, becoming more expensive.
I mean,
still a problem, but
we had Powell say transitive again a couple of meetings ago. I think he'll be reluctant to repeat that. I think he got a little backlash. But no, it's true. I think, especially if you take the stance that Trump tariffs are going to be a short-lived a short-lived development. I mean, we've already seen trade deals reached with Europe. There's been a truce with China. You know, that there is progress on the trade side, and I think Trump is keen to strike deals where he can and where he sees that as.
Well, you say there is progress, but that progress has resulted in 15% tariffs, which are the inflationary driver, really, aren't they? And and again, when it comes to the employment side, unemployment is still at the low 4% range. So as yet, there hasn't really been that material deterioration in the employment market, unless they think that's coming with the revisions to payrolls that we've seen in the last months.
It's true, and I think, you know, that with unemployment below 5%, there's not too much to worry about. I would say that a lot of that is driven by the participation rate. So you've got to kind of that the Fed as well are going to be looking at all different indicators. If you look at continued claims, for example, that's the highest since COVID. So there's a lot of different metrics to consider, and the Fed will try and take a holistic view of all of them.
Just a quick word on Lisa Cook and what this implies for procedures going forward.
Yeah, well, Trump sent her a letter saying she's fired.
Yeah.
And then she said, "You have no authority to fire me." I believe she's contacted some lawyers. So if you're a lawyer, it's probably a good time to be involved in this kind of work. But for everybody else, it's just another level of uncertainty, right? It's like, you can never tell what's going to come out of Trump's mouth next, who he's going to target. So it's just going to destabilize or, like, you know, instill the sense of uncertainty even more.
Yeah, I think that's sort of the real thing to focus on here is, you know, yes, I mean, he seems to have gone after her for supposedly being fraudulent in mortgages and that. But one of the first headlines that sort of came out this morning from basically from the East, from Japan, on trade open, was just people remarking, how can you have any faith in, you know, the underlying strength and quality of the US? You know, we're going to be looking at a number of things here. I think Intel is a particularly interesting picture as well. You're seeing a really interventionist and also quite morally flip-flopping US government here. So it just makes any investment in the US a lot higher risk.
For sure. I mean, I think, you know, he was for a long time challenging Powell, you know, threatening to fire Powell, and that kind of lost a lot of steam. I think he quickly realized that wasn't an option. So this is probably just an effort for him to try and give the illusion of maintaining control over the Fed. And I think it's interesting.
I think she might be a bit of collateral damage maybe to their dispute rather than
and he seems to have picked one of the dovish members as well, which is
absolutely
slightly confusing.
Yeah. Although he's himself in the foot.
One nominated by Biden though, so there is the political aspect to it as well. In 2022, I believe.
Alliance.
It's true. So. But at least fire one of the hawks if you want to raise that, you know.
Yeah, and worth just flagging the chart that we're putting up on the presentation now. So the 2-year break-even's creeping up again, and so this issue of inflation is, you know, it's really going to be the talking point probably for the next 3 years of the regime.
Definitely, and I think this is some of the kind of confusion with why flip dovish now, right? You know, we've come off the back of 2 months or so of relatively muted inflation. And now we're starting to see core measures creep up. We've seen here the Philly Fed input costs soared from 58.8 to 66.8 in August. That's the highest since May 22, which was the pinnacle of post-COVID inflationary pressure. PPI, PMIs, core CPI, all coming in relatively hot. So why flip dovish now? It seems confusing to me.
Yeah, slightly bizarre. And obviously we've been seeing a huge impact on you know, a range of assets in the US, but particularly the dollar. So there was an immediate sell-off on the 22nd, and it sort of regained. But then yet again, the overnight news of Lisa Cook getting fired, we saw a sell-off again.
Yeah,
you know, who wants to be an FX trader right now?
Yeah.
It's all, I don't know, I can't help but feel like the dollar sort of should come lower in the sort of short to medium term here, which yet again sort of plays into Trump's plans on export competitiveness.
And, you know, as we were saying last week, that kind of super crowded short dollar position has kind of flushed out a little bit over the past couple of weeks. So perhaps now funds will start getting short again.
Yeah, and in terms of sort of inflation-proof trades.
Yes.
If you're concerned about sinking money into bonds or even into equities primarily held in the US, we've seen alternatives such as gold. I mean, it's still testing this upper limit, and it's
still
on a
pretty
2-week
range
high.
bound.
But
we've bounced off that kind of lower trend support line, which kind of makes me think maybe there's some room to the upside. I think it'll be challenging though for gold in this kind of risk-on environment that we've started to enter. Equities are performing. We're seeing yields come lower as well. So I think it's going to be a challenge for gold. But the thesis remains: if we have inflation, that's where you're going to want to see.
Yeah, I find it interesting from a trader and a trade craft perspective, because personally I quite like precious metals, and gold being the gold standard of precious metals. I like that, and I'll look to any of these highlights and the announcements over the week, questions over the Fed, US government. I think surely gold's got to test this upper limit and break out higher, but it seems, unfortunately, for me, to be sort of stuck at this all-time high level.
I mean, we need the central banks to start buying again.
Exactly. So in terms of other commodities, Brent, we're seeing a bit of a sort of mixed bag here on Brent. It's we're caught in between narratives, I'd say.
I think there's a fight between the geopolitical aspect and the kind of the supply and demand fundamental side, because we were going into the other week's Russia-US summit in Alaska with a lot of people thinking, okay, this is the first step towards the end of the war in Ukraine. Russian energy products can come back into the global market uninhibited. And that just hasn't happened. The progress is stalled completely.
I think there's been somewhat a kinetic escalation between the two.
There's more targeting of energy infrastructure, refineries, pumping stations, ports, etc. And meanwhile, you got the big forecasters still predicting the massive surplus of supply over demand in the next year or two.
Yeah, I think you've got a couple of things going on. I think you do have that strategic buying from China, which moderated a bit last month, but I imagine will pick up again with flat price this low. You also have a super crowded WTI short position. I mean, shortest CFTC report since 2009. So there's not much more room for it to go to the downside. At the same time, you have a lack of breakthrough on the geopolitical side. It makes sense that it starts to rally, but where do you see this going?
I think you can get higher. I think you can get to 70. Once the dust has settled a bit on Russia-Ukraine, I think we'll see a bit of a recalibration again, maybe return to more of the view on fundamentals. And then at that point, it does really hinge on China, I think. If China keeps buying, it will remain supported. If China takes its foot off the gas and says, okay, we've stockpiled enough for now, then it can free fall pretty quickly, I think.
If you were to see a potential support, as you've just said, would you see that pass through to WTI? And if so, I presume we'd expect volatility to be quite high if people are overwhelmingly short and not being able to make any money on that trade.
Definitely. I mean, for a while, WTI wouldn't clear into Asia. I mean, India are reluctant to buy WTI from a kind of a diplomacy perspective. But I think, definitely, if we start to see WTI clearing into Asia, that could open up that arb, and we could see those shorts get squeezed out, and that could see a serious break to the upside.
Yeah, so worth flagging that, of course, Onyx have training for traders that we do on Flux. You can have that in person and on online courses. So anything like this, and if you're interested in tradecraft around WTI, keep an eye out for our training courses. So talking about Chinese buying, obviously it's not just in oil. We've seen optimism across Chinese markets a bit over the past week or so.
Definitely. I mean, one of the key metrics that I've noticed has been the five-year forward rates, which are a measure of inflation expectations. China have suffered with pretty systemic deflation for quite some time, ever since the kind of collapse of the housing market. So the fact that that's starting to rally a little bit really says a lot. I think the markets in general, bad news is good news, good news is good news. They want to be bullish on China.
Yeah. No, I think it's definitely the case, and seeing that the CSI 300 breakout, everything seems to be being passed on. these bazookas, whilst, we've cited a number of times that the German stimulus package, these things don't make an impact immediately, and especially if saving rates are higher, which they typically are in China than compared to sort of even Europe, but especially the US. These stimulus packages take a while to be passed forward, but I think they're seeing the fruits of their labor a bit here.
Yeah, and I think equity markets are typically very forward trading, so you're trading on expectations, and at the moment they seem to be gearing up for more stimulus. The PBOC, although they've been pretty steady the past couple of months, I think we'll probably be expecting a cut there, especially with CGB yields starting to creep up. But we saw a softening of retail sales this last month. Yields are still relatively low on the CGB at below 1.8% compared to the US where it's 4.3%. So that just gives them a lot of ammunition to be able to fire at the economy. So we'll see probably more of those consumer repurchase programs.
Agreed. But you mentioned the CGB yield. I think the 10-year as well spent a long time struggling to get anywhere above 1.6%.
Yeah.
So to see it up consistently towards 1.8 is progress of a kind for that.
Definitely.
For their market.
And then shifting topics a bit, looking at the UK, we've seen UK long end yields are now higher than US.
Yeah.
And Greece.
Yeah.
Which is a worrying one.
Yeah. No, I mean, it's clearly quite concerning. I think this is, again, as we mentioned last week, pointing towards a bit of a trust moment.
Yeah, what's the narrative here? Why are we seeing long end yields so high in the UK? Just give us a layman's rundown.
It's purely fiscal sustainability.
Yeah, too much spending, not enough inflows. That's what it comes down to. It's more spending is higher than they have the money to spend, and it has a result.
We have 30-year yields over 5.5%. We have debt servicing costs at 111 billion annually, so £1 in every 12 is spent servicing debt. The deficit is now around 50 billion, and growth prospects are pretty poor.
Yeah.
So there's no way we're going to grow out of the debt burden, which is slightly different to the US. I think growth markets are generally quite optimistic about US growth.
Of course they have,
over the medium long term, that is.
Exactly. So huge debt that is compounding, but they seem to be, constantly, at least the narrative is discussing it, and there seem to be, ideas put forward. I think the UK is in a very worrying situation, and there seems to be a lot of, discontent surrounding even, I think, this idea of brain drain. It used to be, London and the UK was a source for a lot of productive people to come over, and you would see brain drain flows in the other direction where highly skilled people were coming to the UK. I think now, because of increased tax rates and things like that, the narrative at least is now flipped, and people are concerned about sort of the best and brightest escaping, whether it be to Europe or to Dubai or to I don't know what. So.
Definitely.
And we were discussing earlier the Philly Fed Manufacturing Index, but new orders, they're now back in contraction as well.
So it's painting a pretty poor picture of manufacturing in the US. Hardly surprising, really, when you have such a volatile import environment. So I think, especially, copper, for example, Trump was threatening tariffs on copper and then took his foot off the pedal. But that makes it very difficult to forward plan. And I think, the manufacturing sector in the US is struggling. Another key factor is rates being higher for longer. So I think hopefully if we get a cut in September, that should help the US manufacturing sector. But all the indications are pointing towards,
Yeah, I think so. And I think
soft manufacturing.
Retailers also are struggling as well. Because you got, for example, General Motors and Walmart. Both of those obviously huge retailers, huge corporations in the US. And in their earnings statements, they've said that they've paid hundreds of millions more this last quarter on tariff costs.
Yeah.
And that is going to have to feed through to end users, right, to the consumer. They can't just afford to keep paying out these massive additional costs.
Yeah.
And it has to feed through to their
retail operates on very thin margins typically. So in these competitive markets, if your costs go up, you have to pass it forward if you want to remain a going concern. In the short term, you can eat it for a little bit, but in order to retain market share. But
and then if we're looking at the consumer, if prices paid for all of these goods are increasing, we're seeing these pass through on house prices, aren't they?
Yeah, I mean, house prices are starting to wobble a little bit. So we've seen home prices fall to in a record of 39 major US metros in July. And I think this is a function of rates. The average 30-year fixed rate mortgage is a function of the 10-year Treasury yield, and that itself is pretty responsive to one, fiscal sustainability, but also real yields, and also the Fed funds rate and inflation expectations. So all of that is painting, I think, a pretty dire picture for the housing market. We've seen 10-year yields there about 4.3%, some way down from their peak, but on the rise again.
I mean, this chart that we have up here, of course, it's month-on-month decline, and I think it's worth just citing with that, with the uncertainty around people's futures, consumers and mortgage applications. Yes, they're very dependent upon interest rates, but they're also dependent upon sort of consumer confidence, long-term consumer confidence. And I think a lot of people are worried about, inflation expectations, but also just concerned about whether they're going to be having a job, full stop. Because no matter what the headline level of unemployment is, etc., the number of people getting second and third jobs is even higher. Middle class is being squeezed. Disposable income's falling. We've been seeing year on year things like amount of money spent by the average US consumer on holidays decreasing because they don't have the extra money to spend. So when that money dries out, they worry about their ability to pay a mortgage.
Service their fixed costs.
Yeah, that's exactly it. Now, the S&P.
Yeah, equity markets, more concentration. The concentration of the top 10 companies in the S&P has reached 39.8%. So that's way higher than even in the dot-com bubble. It looks a bit precarious, doesn't it?
Yeah, I mean, when you've got 490 companies, or 493, however many they actually have, it's slightly over 500, but that are only 60% of the market, that is a bit concerning. Now, obviously, NVIDIA's closing in on the Japanese stock market in terms of market cap as well. So as soon as you get one of these big monsters of a stock, all it takes is that one to have a wobble. Suddenly, everybody's portfolio is dropped by 10%. And panic sets in. Retail, obviously, at the moment is extremely leveraged in their positions. So that does lend itself to a potential downward spiral when we're so retail heavy in these top stocks.
Yeah. I mean, it'd be interesting to see actually if there is an unwind, how retail play that. Because, during COVID, as we mentioned last week, I think, they held on. They tried to ride it out, even with the massive drawdowns, and they came out. On top.
And repeatedly, we're seeing more buy the dip kind of headlines, and more evidence that retail has just kept on buying. So I think it's a question of, if prices do go down, how much pain can they withstand?
I think just to see, obviously the concentration in basically the Mag 7, etc. One change in the wider environment, whether it be a scandal at these companies, whether it be new innovation, whether it be patents failing.
Well, this morning Trump threatened export restrictions on chips if foreign countries don't relax their restrictions on US tech in their own country. So already there you've got one thing to worry about.
So it's definitely a precarious condition for the S&P to be in, and given the concentration. But if we look at the sort of zombie firms, they're also creeping up a bit.
Yeah, I mean, Goldman Sachs non-profitable tech index, which tracks firms that are actually loss leading, but that has been rallying almost 66% since the April lows. So I mean,
it's just a buy everything environment.
These firms are not profitable, to be clear, but we're seeing the valuations seemingly rise exponentially. I mean, it seems seems a little bit bubble-esque to me.
I think it's also perhaps partly a function of the index fund investing that has arisen over the last, say, 5-10 years, because you just buy a whole market fund and suddenly you've got a bit in everything. So if you've got a vast number of investors putting their money into these funds, then naturally that's going to allocate to whatever's in it, no matter how profitable or unprofitable that company might be.
Well, that's exactly it, and that's why I think a lot of people will always look at now the firms that are on the peripheries of being included in, whether it be the FTSE 100 or the S&P 500. If you're suddenly at risk of going out of that, then getting short that stock is going to be perfect, because all of these trackers that literally will buy one share of everything. They exclude you once you're out, so it's an easy one to sort of trade at the peripheries there. And then Palantir, this was we've had a bit of a roller coaster there, and if you talk about retail having diamond hands, it's an interesting one. It seems to have absolutely had a nightmare over the past few weeks, and now seems to have found a bit of a bottom here.
Yeah.
We said just before coming on, you could have effectively just drawn a line across and cut out that massive peak.
Yeah.
And I think it was just a bit of mania really driving it. And then perhaps sudden panic, thinking it's gone up by 20% in however many days. It can't keep going. And then just kind of a spiral of selling again to bring it back down. But it is, last few sessions, it has kind of steadied a bit in kind of the 150s up $150 range.
Yeah, I mean, it was a crowded trade, really, wasn't it? Everyone was jumping on board just because it seemed to have strong upward momentum. But we reached crazy ratios. Price to earnings was like 600%, 600 times.
By the way, guess who called the top? Jim Cramer said at 190, he's not going to wait until the bell to get to 200, and it immediately nosedives.
Inverse Cramer always performs. And just looking now as well at the CAC, so we've seen the confidence motion. That's
in France. So the Prime Minister has tabled a confidence vote in the government for, I think, the 8th of September or so.
Yeah.
So that could see them kick out their second Prime Minister, second government in less than 12 months.
Yeah.
Because Michel Barnier only lasted 3 months. Currently, the Bayrou, who's currently the Prime Minister, he's only been here since December. Yeah. And yet it just tells you how ruined French politics is. Yeah. They've gone through this many governments so quickly, and I mean,
5-year credit default swaps hitting a 3-month high as well. That's a classic telltale sign.
Yeah, and I mean, if you look at the spread to bunds as well on the 10-year French out, that's blown out from about 65 to almost 80 basis points. So it's equities falling, yields rising. It doesn't paint a particularly positive picture.
No. And then speaking of the Bund, we've seen German IFO. If we're seeing things overall not looking amazing in Germany, to see France struggling so much, really.
Yeah, well, the IFO is an interesting one because the release yesterday showed that current conditions was slightly below expectations, around 86.4, I think. But the expectations improved, and they've been improving pretty consistently. So on the chart, you can see that since April, they've improved every month. And if you look back to the beginning of January, that's a pretty consistent improvement throughout this year so far. Yeah. So I think it is partly the new government, the stimulus that they've promised and that they've delivered. And also I think maybe just a bottoming out of expectations that it can't get any worse, so it must get better. Exactly. That might be part of it.
I think this measures survey respondents' view of future conditions. And I think you've always got to remember where the base is here. I mean, the expectations about the euro area economy more broadly had been pretty poor for a long time, and we've had a number of new developments. One was potentially an unwind of tensions between Russia and Ukraine, potentially, which didn't materialize, but at the time of the survey might have still been providing a boost. We also have this looming fiscal package from Germany coming through, but we also have the ECB, which I think is getting less and less patient and will probably have to cut again soon. So I think there's the expectations being good is probably not too surprising, but the current conditions are pretty poor.
Yeah.
And Bitcoin, we're seeing that sort of $110,000 support being threatened a bit here.
Yeah.
Where's the new key support? Do we like Bitcoin, or is that going to dump? Or?
I don't know. I think the 100,000 is a very significant psychological level. When it broke above 100,000, you can remember all everyone was talking about how crypto is going to the moon. It's 1 million is next.
Yeah.
So I think if it gets back to near 100,000, we could see perhaps quite a lot of buying coming in. But it's coming down pretty consistently from its high a couple of weeks ago.
Yeah, I wonder, it's interesting to see Bitcoin come off despite things, some alternative investments like gold being relatively supported. I suppose maybe the affiliation between cryptos and the current US political regime is positively correlated in that sense. And yeah, alluded to it earlier in the show, Trump buying Intel. This seems, to be, I don't like this intervention at all, but what are your guys' thoughts on it?
Well, I mean, I think it's doesn't make any sense really. So he's supposedly saying that government grants will be able to be converted into equity, and therefore the government will be able to have a stake in a private company, Intel. Of course, government intervention plays a role in the economy. We've seen governments come in and try and rescue failing industry, but it rarely works. And Intel, I wouldn't describe them as a failing company. They're facing a lot of competition from the likes of AMD and Nvidia in the chip game, but they're still relatively successful. They don't need a government bailout, that's for sure. So I think it's a way of Trump trying to reclaim some of the spent money to offset some of the bucks.
I find it really weird as well because, obviously, traditionally, the Republican Party, more free market, etc. If you were to look back at, Milton Friedman and the likes of that and his doctrines, at the absolute most, I think he would advocate for government intervention in things like the laws and then some public services. To go and intervene in a private sector company screams of inefficiency, let alone going into a private sector, going into a private firm that's already failing and isn't necessarily going to be fundamental to defense or to US suzerainty going forward. I don't get it. I find it really weird.
To put it bluntly, he's sticking his nose where he has no business. He's showing off, I think, trying to show how powerful he is, how he's kind of Rayman, he's like making a kingmaker effectively.
Exactly.
These individuals. He's effectively done it with Boeing as well. I mean, if you look at the number of trade deals and tariff deals that have involved pledged to buy China, however many Boeing planes, and the effect that's had on the Boeing stock has been astronomical. So he does have these kind of chosen sons, and it's frankly, like you said, it smacks of government interventionism.
Yeah.
Cool. Well, sort of in the conclusion, let's look at central bank OIS pricing for the next 12 months. We're seeing, obviously, Powell and the dovish Fed stuff, 114 bips.
Yeah, that's crept up about 4 basis points since last week. Also, the ECB only 19 basis points. I think that's probably going to have to fall a little bit further than that.
Also, they're going to be quite desperate, aren't they?
Yeah. That's for sure.
Yeah. And then Japan stands out as well, obviously, because it's in its own hiking cycle. And, like we mentioned earlier, the 30-year yield is up to record highs this morning. So 3.2%, it's they have to get something sorted.
Yeah.
So.
And then looking forward to the week ahead, obviously we're on Tuesday today. We've got some decent data coming out this week.
Yeah, on Wednesday, we'll have China industrial profits. We'll have the GfK consumer confidence, as well as MBA mortgage data from the US.
And then on Thursday, you've got the Euro area economic sentiment. That'll be an important one following the IFO that we got yesterday, and consumer confidence, plus then US GDP for the second estimate.
And then on Friday, we get Japanese data out, retail sales, consumer confidence. You get German retail sales, Euro inflation data. So yeah, thank you very much for watching. I hope you all enjoyed and have a good week ahead. Thank you.
Thank you.
Thank you.
Goodbye.